This week, Learning Saturday, we have 3 exciting webinars lined up for you. At 10 a.m., we start with Safe Investment Playbook with M2W, where we will discuss a safer and structured approach to investing. At 11 a.m., we have Gold and Silver in 2026, exclusively for Malaysian and Singapore NRIs, focusing on what to expect and how to position again. And at 1 p.m., we will cover Navigating Gold and Silver Trends, exclusively for NRIs in the UAE. To join all these webinars, kindly click the registration link in the below.
Hello everybody, welcome back to another episode of Know Your PMS for ithought Connect. In today's episode, we are going to be discussing some basics and also deep dive into aspects like attributing every PMS product of ithoughts to a different goal. And for this, I have with me somebody from my team who's been doing this for a while. Vinayak Sangeet Kumar. He's a familiar face on multiple social media channels. You might have seen him. So the first question for Vinayak, hi. So the first question for you today is going to be, given that you deal with a lot of investors who are probably young, how would you pitch PMS to them? How do you think they will understand PMS versus MF?
So to simplify, as in PMS, it's similar to like a mutual fund, where you have a designated fund manager assigned to that portfolio. And similarly, it's a basket of portfolios or stocks that you manage for the investor. So to simplify, SEBI has a mandate that for a PMS, the minimum investment size should be 50 lakhs. Whereas for mutual fund, that is not the case. And mutual fund, it can be, look like a one shoe fit for all size. It's more like a model portfolio, where PMS is customized portfolio, where you have different strategies like multi-asset, pure blue chip, pure small and mid cap. And there, the entry point is the main deciding factor. You might not have a model portfolio allocation. Every portfolio is going to be unique based on the liquidity that the investor brings into that portfolio and how the fund manager deploys that capital. To simplify, mutual fund is a one size fit for all product. Same portfolio for multiple set of investors, where if you own or do your direct equity investments, in that case, you choose and manage your stocks yourself. Whereas in PMS or a portfolio management services, there is a proper research and strategy team, like a mutual fund, but it's going to be curated for a specific individual portfolio or an individual investor.
Right. Okay. So now that you mentioned that there is a flexi cap portfolio, there is a multi-asset portfolio, right? Can you walk us through the different products, or can you walk the audience through the different products that ithought offers and how you go about mapping every product to a different financial goal? If you can give us some examples based on which product would suit what financial goal and which risk profile for an investor.
So I would say every PMS strategy in our ecosystem has a different unique personality, and that portfolio, it differs from person's type of each suits different investors type of financial goals and their risk appetite. We'll start with a flagship portfolio that is Solitaire, in which we invest across large, mid and small cap companies in India. So as an investment philosophy, we are more long-term value investors, and we have a contrarian style of investments. So our end goal is not, for example, to mimic benchmark or slightly shift away from the benchmark and to find right value pick. So Solitaire portfolio is one portfolio where you get all the necessary allocation in Indian equity space, whereas in large, mid and small cap, except banking, because we generally try to avoid companies with leverage or debt in their book. That is one specific thing. Typically, most long-term investors fit naturally into this bucket, because this is going to ending up complementing their portfolio for the long-term wealth creation. So I would generally map a Solitaire portfolio purely for something, like a time horizon of 3 to 5 years plus. If you have some wealth creation goal, retirement goal, or just proper, for example, if you want a compound wealth and you already are running an investment portfolio, this PMS would be a great fit for your existing investment journey. Second is Sphere. It's a dynamic multi-asset portfolio. In this portfolio, we invest across different asset class based on the conviction and the opportunity that we have. We don't have a benchmark allocation of minimum 60% or 40%. We can go 0 to 100% any asset allocation or asset class based on the opportunity. We do equity, mutual funds, gold, silver, global fund of funds, and even debt investments in this portfolio. So in that case, I would say this is one of the portfolio where it's like an all-weather portfolio. Even markets are down, or gold is going up or so on, this portfolio will give you a consistent compounding experience, like a moderately conservative portfolio. So this portfolio is very important for you in your overall asset allocation. If you're just inclined towards equity as an asset class, this portfolio will give you the right exposure towards right asset class at the right time. So Sphere is that dynamic multi-asset portfolio. We do have something called as NEO. This is specifically for NRI investors, and the NEO full form itself is NRI Investment Opportunities Fund. Why we do have a separate portfolio like NEO, similar to Sphere? Because specific countries like US for their NRIs have a lot of restriction for investing in mutual fund. So in NEO portfolio, it's again a multi-asset portfolio where we invest across different asset class, but we only invest in stocks and ETFs. Whereas in Sphere, it is a mix of stocks, ETFs, and mutual funds. So third, I'll shift to blue chip. That is, True Blue is a blue chip portfolio in which we actually only invest in the creamy layer of, let's say, the large cap companies in India. So this portfolio is suitable for someone who is more, let's say, inclined towards wealth preservation at a very conservative risk appetite, and more or less, let's say, in my client base, people who are already transitioned to retirement, or they need something, let's say, like a proxy for their FD at a good consistent compounding experience. True Blue is a good fit for the long-term wealth creation. And finally, on the risk, let's say, appetite, or let's say the most aggressive portfolio that we run is Vriddhi. It's a pure small and micro cap portfolio where I would recommend for an investor who has already experienced market, has a long-term wealth creation, let's say time horizon of 7 to 10 years plus, can, let's say, for example, be part of this Vriddhi portfolio. Because more than just, let's say, numbers or, let's say, return expectation, you need to have the stomach to, let's say, accept the volatility that this kind of segment brings in also, and also help you scale up the portfolio whenever there's an opportunity. Because all the portfolios that we run, it's not that you just invest 50 lakhs and forget. You need to scale up your portfolio whenever there's an opportunity, and that is the main crux behind it. So if you have a longer time horizon, and if you can, let's say, stomach the volatility and have a high aggressive risk capacity, Vriddhi might be a good fit. So to summarize, Solitaire is a flagship portfolio where we invest across large, mid and small cap companies. Sphere and NEO are a pure dynamic multi-asset portfolio. The difference in Sphere is we invest in stocks, ETFs, mutual fund, whereas NEO is more customized for NRI investors, only stocks and ETF. Blue chip product is third is True Blue, where we invest across only large cap companies in India. Fourth is Vriddhi, which is a pure small and micro cap portfolio.
Interesting. That was a very extensive answer on each of our products in our ecosystem. Just an extension. So when you speak to a client, how is it that you map every product to a goal? In the previous answer, you mentioned that a lot of your clients who are closer to retirement, they go for True Blue, right? So how do you map, say, a goal like child's education to a certain PMS or any financial goal for that matter?
So I would say our process is more about goal first, not just selecting the product and forgetting about it. Because here we want our investor to, let's say, enter into a specific product that suits their, let's say, profiling or, let's say, their financial goal requirement. So first thing is, let's say, analyzing their goal. So what is the timeline? It is more about capital protection or capital preservation, because if you have a short-term goal of 2 to 3 years, we would not recommend a PMS portfolio, because you should at least come with a 5 years time horizon for the fund manager to do the job for you. So second thing is, are there any immediate cash flows needed? That is one thing. So then next we go to analyzing the investors' portfolios. So before that, we understand the investor's risk capacity, the time horizon the investor has been part of, let's say, the portfolio or the market. Let's say, for example, if investor is only coming with a 50 lakh capital, we might not, let's say, recommend you start directly fresh with a PMS, because the concentration risk also increases. So if that is the case, we would actually ask them to start with a mutual fund, scale up the portfolio, then let's say rethink about a PMS strategy at a later time. And one thing is, let's say, for example, why I mentioned about risk capacity is one important factor. We have our own, let's say, risk questionnaire that we send to the prospective leads or, let's say, existing clients to understand the risk capacity. There are just 10 to 15 questions. After answering that, we'll understand what is the risk capacity of this investor. Based on that also, we get an idea about, okay, what product might suit them. Also, it's like more important factor is the time horizon they have been in the market, because last 5 years has been great for all the investors. So that itself comes with a different expectation of returns. So you need to come with the right set of expectation within the portfolio with a long-term approach. That is one thing. The aim is to select the right product based on the financial goal requirement of the investor, analyzing their cash flow, liquidity, whether they can scale up the portfolio or just one capital that they're going to invest and forget about it. Next is analyzing the investors, let's say, behavior on, let's say, the risk capacity, their existing portfolio. We review the portfolio, give the feedback, and then identify what are the gaps and choose the right product for them.
Okay. So you speak about identifying gaps in an investor's financial goal versus the product, right? So in the first level of conversation with an investor, whether young or at a certain age, what do you think are certain misconceptions that they have about investing in a PMS, given that A, it comes with a larger ticket size, and B, it's a customizable portfolio. So, and ours is also a discretionary PMS. So, what do you think are some misconceptions that
So
you
one
see?
thing that we generally hear about is PMS only for high risk investing. That's not completely right, because there are portfolios like conservative product like True Blue, multi-asset portfolios or strategies where we aim to have lower drawdowns just compared to an equity portfolio and so on. But still, the idea is if your time horizon is longer of 3 to 5 years, then it might be a good fit for you. If you're coming just for 1-2 years or just 1-2 quarters of returns and so on, PMS might not be a good fit. So that is one of the misconception. Second is PMS guarantees higher return than a mutual fund. So I would say it's not about that entirely. It's more about the discipline and let's say the contribution of let's say capital apart from the initial capital that also matters. Let's say for example, there's something called as rule of 72 that I always talk to my investors. So let's say you assume 12% from let's say index or let's say any portfolio that you invest in. So generally, so 72 divided by 12. So let's say you compound your money every 6 years, or let's say double your money every 6 years. So in that case, what we generally want you to be aware of is there are going to be more opportunities on a specific financial year. It can be let's say like the Russia-Ukraine war, or let's say the Trump tariff announcements, a lot of small here and there announcements. So at that time, as an advisor and the fund manager, we identify opportunities and come back to you to scale up the portfolio. If you're able to, let's say, contribute capital at that opportunities, the compounding can happen quicker, and let's say the doubling of money cycle need not wait for 6 years also. So hence, it's not more about just that PMS gives better returns than mutual fund. The only thing is contribution and discipline from the investor also very important thing here. One more, let's say, misconception that we are hearing a lot is once I invest in PMS, I need to see the returns quickly in next 1-2 quarters and so on. So any product that you enter in, let's say, has a own deployment phase. Let's say our PMS portfolios are not a model portfolio. We have our own standard customized deployment plan based on the opportunities that are there. It might take 6 months, 8 months for the deployment itself. And it's a long-term wealth creation portfolio that we're building for an ideal time horizon of 3 to 5 years. Because we have conviction in the ideas that we're investing in. And at certain times, we might be very early in cycle also to identifying the opportunities. So there, if you come with an assumption that within 1 quarter or let's say within 1 year, you need to see the return, that is one misconception.
Okay. So conviction plus contra is something that ithought does, and I'm sure a lot of our viewers are aware of. I'm sure a lot of you are also aware that we have a program called Milestones to Wealth, which helps every small investor, or every investor for that matter, reach their first crore through investments in mutual fund. But now the question to you is going to be, how do we position a goal like this for a PMS product where the minimum ticket size itself is 50 lakhs?
So think of this as a continuity of your existing milestone to wealth part itself. So to simplify again, milestone to wealth is simply we encourage young retail investors or let's say new investors to set a realistic let's say milestone such as 2 lakh, 5 lakh, 10, 25, 50 and all together to 1 crore. That is the path or let's say wealth creation that you're putting there. So why we set this realistic targets is because when we have a specific milestone, we are more serious about our investments. Similarly, let's say for a PMS where the initial capital itself is a 50 lakh, we have something that we run called as $1 million milestone portfolio, wherein our target is to take you from 50 lakhs to 8.5 crores, that being the end goal. But that also we are going to break it down to small achievable targets, like let's say 1 crore, 2.5 crores, 5 crores, 7 crores and 8.5 crores and so on. So here what we do is, let's say for example, you already will be doing some investments in your 50 lakh portfolio that you start with. We see assumptions on, let's say if you do monthly SIP, step up, annual top up, or let's say combined strategies, how quickly you can reach that 8.5 crores based on your current, let's say capacity. That is where we are running this $1 million milestone. And if you're already being investing with ithought for their PMS portfolios, you can reach out to your advisor and inquire about this $1 million milestone.
But I'm sure you understand that with more money comes more risk. And that's a mindset that a lot of investors have. And being client facing, I'm sure you get asked this question a lot about how are you going to manage my risk and how am I going to see performance. So how do you handle these questions and how do you communicate to the clients about how ithought does risk management in various portfolios?
So 4 key messages always help. Performance is cyclical, process is constant. We don't chase, let's say for example, returns on the short term. We chase longevity and quality, because if you have the right standard of process and let's say for example, scaling up your portfolio is done right, the returns is something that will happen. Because we always hear this term from our team itself that you should not wait for returns to come in and start loading the capital. You need to front load the capital initially and then backload the gains at the end of the cycle or curve. So second is risk management is something that is not visible on a day-to-day basis. This is something that will reflect on some, let's say, big correction or drawdown that happens, just not only during the bull run phase that is there in the market. The goal is to not chase best return every year, but to avoid mistakes by proper standard and research. So I would say for a long term, client could appreciate this honesty and realistic, let's say, view on any process.
Okay. Again, as an extension to that question itself, how important do you think it is for the investment advisor to communicate to clients, and what sort of communication needs to go out to such clients? If you can cite a few examples, maybe from your personal experience itself.
So as an advisor, the primary role here for us is to, let's say, educate and keep clients updated about market rationales and let's say the right, let's say, news, and help them avoid the noise that is there in the market. It's more about communicating the outlook, setting the right expectations, and not just every small market move that we do in the portfolio. So I would say there are a few metrics that we do internally itself. So we run an initiative where we reach out to our existing clients on a monthly basis by a lot of webinars that we generally do on a weekend. And apart from that, we do client-only webinars on every quarter. Second is, it's like every week, a fund manager itself writes down a market wrap to give a heads up or update about, let's say, what's been happening in the market. And that will give you a precise idea about, let's say, what we are thinking. And apart from that, to set right expectations and so on, we also do, let's say, a corporate earning webinar on every quarter. That sets you and gives you, let's say, a realistic view on what you can expect in the upcoming quarter and let's say where the market or let's say the noise is going to lead it to. Apart from that, we also send in a monthly comprehensive report of your portfolio where you can track, let's say, what is the performance appraisals and holding statements and everything. And lastly, we also make sure that we do some executive checks internally where our fund management team reaches out to the investor. We'll be having a quick call, 10-15 minutes call, where we again revisit the investment philosophy, set the right expectation, and also understand, let's say, what are the other, let's say, troubles or let's say problems that the investor is facing from their behalf. So we have been doing these outreach sessions, and our existing investors who had already been completed or let's say will be still planning to do some more by this year.
Right. So with all the communication that is coming to all of you, and apart from this, if you are looking to get any advice on your portfolios, there is a team designated that will do investment reviews for you, whether it's within the organization or if it's an external portfolio. Stay tuned for the next part as we speak about some more interesting things such as the M2W equivalent for PMS clients, as well as some aspects that will help a lot of our viewers who are already clients and of course who will like to be onboarded very soon.